Warren Buffett, for the longest of times, has recommended one investment.
Consistently buy an S&P 500 low-cost index fund.
Recently, news came out, though, of him doing the exact opposite.
Warren Buffett just sold the S&P 500 index funds.
Common knowledge has always taught us that buying an index fund and holding is the right thing to do. But with record prices, Buffett's selling, and concerns about America, is index fund investing really the smart choice still?
It's not just me, but a lot of people say, I think the odds that the S&P delivers over 5% returns a year approximates zero.
How to invest. Don't make it any more complicated than it is. You can own the stock market through an all-market index fund.
Michael Murray says index funds will collapse.
This is the best, safest, and easiest long-term investment strategy. Talking about Vanguard index funds.
Index funds are not great for you. In some cases, it can be downright bad.
One of the best methods to invest your money, and that is through the use of index funds.
I generally think of like the S&P. It's a Ponzi scheme these days.
Just buy an index fund and never look at a headline, never think about stocks anymore.
Berkshire Hathaway fully exited the SPY and VU holdings, which means they fully sold out of the S&P 500.
The only question is, are index funds still worth owning in the modern day, or are they an overpriced asset just waiting to collapse? If you own index funds, you don't want to miss this one. The index fund on paper is the perfect solution to the investing question. Choosing individual stocks is not an easy thing to do. You have to understand balance sheets, regulatory risks, you have to assess valuation metrics, make forward projections, calculate intrinsic value. The index fund solves this entire problem by not choosing individual stocks, but instead buying the entire group of them. This way, as the stock market as a whole goes up, which historically it has done, you as an investor profits. You don't have to do any of the hard work of picking individual stocks. You diversify the risk of owning that one stock that collapses. The investment is quote unquote safe with the index fund. It's for these reasons why so many respectable investors say,
You can own the stock market through an all-market index fund.
Most investors should be using low-cost index funds.
Just buy an index fund.
So we do need to ask ourselves, well then why would Buffett sell his index funds if they are such a perfect investment? And don't worry, I'm going to go into the exact details of Buffett's sell a bit later to give you the context around it, because there's a little bit more to it. But it's at this point that I want to introduce to you something that is not talked about by traditional finance creators. There's a problem with index funds that you will not hear from most people. Before we get into this problem, I want to thank the sponsor of this video. One of my passions in life, as you all know, is investing. I've been making content on this topic for 8 years now. With investing, arguably the 3 most important questions are, how do I find stocks, what stocks do I buy, and what's going on in the market right now? This product from investing.com called Investing Pro helps answer these 3 questions. I want to show you how. Investing Pro has this tool called Warren AI. You can think of it like ChatGPT, but for investors. The good thing about Warren AI is it's backed by investing.com's data, so it's not just spitting out random information, it's quality data from one of the most visited financial sites in the world. So let's ask it some questions and see what we get back. Which stocks are good investments based on a low PE ratio? So it gives us a few different examples of low PE stocks, but then says, before you crown them value kings, let's see what else is lurking beneath those numbers. It then gives us the stocks, the PE ratios, and gives us an opinion on what to be careful of. For example, with GI Apparel Group, it asks, are the margins sustainable? For Crocs, it says the market may be skeptical about growth. For Riley Exploration, it says it's cheap, but the risks are potential commodity swings. I really like it how it gives you the data you asked for, but it also says, hey, be careful with these low PE stocks, and gives you the potential risks that come with it, which is actually a wise answer. Who would have thought AI could be wise? But you can ask Warren AI anything like, why has Apple stock gone down so much this year? And then it explains to you about the tariffs and the tech blues and what has pushed the stock down this year. And it's also done in an easy to read layout. You don't have to, have a PhD to kind of read these things. So guys, go check out Investing Pro. Click the link in the description to get an extra 15% off your first Investing Pro subscription. Check it out. Now, let's get back to this index fund problem. The traditional index fund that is recommended by most is the S&P 500. 500 large and powerful companies in the United States, and you own a small piece of each of them. Billions and billions of dollars has flowed into the S&P because, historically, it's performed really well. The problem with so much money flowing into a certain group of stocks is the price starts to become very expensive. With stocks, generally we measure how expensive something is with what's called the price to earnings ratio. If we look at the S&P 500 price to earnings ratio, it is now 28, rounded up. So prices are 28 times higher than what the earnings of the stocks are. If earnings stay the same, it will take 28 years to get your money back on the price you paid. The average historical PE ratio of the S&P is 15. So right now, prices are about double what they have been historically. Okay, so who cares? Prices are more expensive than they have been in the past. Why are you telling me this? You're wasting my time. Well, this is something that the everyday investor doesn't know, but the seasoned investor is acutely aware of. The higher the price you pay on a stock, the lower the expected return on the stock is. Let's say a stock's earnings are $10 in cash every year. Now, let's say you paid a bargain price on that stock. You paid $20 to own the stock. That means you are getting a 50% return each year. Okay, now let's change that and say you paid $200 for that same stock. Now, instead of 50% return, you are getting a 5% return each year. Because you paid a higher price, you are getting a lower return. Investors like Warren Buffett and Mohnish Pabrai are two people that deeply understand this concept.
It's not just me, but a lot of people say that, say in the next 10 or 15 years, if you have an expectation that you're going to get more than 3 to 5% a year from the S&P 500, I would like to take the other side of the bet on that with you. So I think the odds that the S&P delivers over 5% returns a year for the next 10 or 15 years approximates zero. The Magnificent Seven, tell me those cash flows. Run an exercise on your own. Look at the value of the businesses. NVIDIA is valued at 3 or 3.5 trillion. The cash flows need to be in the range of 2 or 3 or 400 billion in a relatively short period. So when is NVIDIA going to deliver a year, single year, 500 billion cash flow? Because if I'm putting out 3.5 trillion, I want 7-8 trillion out of it, right? I want to double my money in a few years. How am I going to get 7-8 trillion? The only way I get 7-8 trillion is somehow there's like that much in cash flows that comes in the next 15-20 years. And I just think that the math on that is hard. So Warren Buffett increasing his cash position, I think he clearly understands that this 3 to 5% is not lost on him. Between us girls, it's not going to be 5%. It's going to be less than 3%.
So, question for you. If you owned index fund, would you be content with getting a 3% return each year on your investment? Some investors who understand the math behind index investing are not content with these lower expected returns and instead look for alternative options. So, to check on the moves that expert investors are making, we go to the website Dataroma. Let's click on Warren Buffett and go to activity. There were 3 stocks in that latest quarter that he sold out of completely. One of them was Ulta Beauty, and the other 2 were, lo and behold, the Vanguard S&P 500 ETF and the SPDR S&P 500. Just remember that ETFs and index funds are effectively the same thing. If you dig through his financial history, you can see that he bought both of these index funds back in the 4th quarter of 2019. So he held them for 5 years until the 4th quarter of 2024 and then he sold. So by this data, he bought the S&P 500 when it was around 2,900 points and he sold around that late 5,000, early 6,000 mark, which is a double. So that's not a bad investment, a cheeky 2x gain in 5 years and then sell. So the headlines of Buffett selling are true, but there's a catch. These sales that were made were worth 0.01% of the portfolio each. They were not big sales by any stretch of the imagination. If you add the 2 sales together, 39,000 shares of SPY is worth 22 million and 43,000 shares of VOO is 23 million. So that's $45 million worth of stock sales. Warren Buffett's stock portfolio is valued at $267 billion. So relatively speaking, it's a small amount, and normally when it's this small, it's not actually Warren Buffett making the moves, but it's the investors under him, Ted or Todd. Nevertheless, some investors at Buffett's investing company Berkshire are selling index funds, and it's just so the case that they are not the only people bearish. Except with these guys, there's a lot stronger warning that comes attached. Michael Burry is the man from the movie The Big Short. Made hundreds of millions by betting that the housing market was in a bubble and would crash. The only reason why I mentioned Burry is because he said index funds are now similar to what subprime housing CDOs were back in the great financial crisis. He said, passive investing, aka index funds, has removed price discovery from the equity markets. The simple thesis and the models that get people into sectors, factors, indexes, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in that price setting in that market was not done by fundamental security level analysis, but by massive capital flows based on noble approved models of risk that proved to be untrue. The flows will reverse at some point, he said, and it will be ugly when they do. Like most bubbles, the longer it goes on, the worse the crash will be. I want to explain for those who didn't quite get that, because it's very important that we grasp this concept. In 2007, before everything collapsed, they were selling these things called CDOs to investors, collateralized debt obligations. Basically what happens here is a bank issues risky home loans to borrowers with low credit scores. That's called a subprime loan. These subprime loans are bundled together and sold to investment banks in what's called a mortgage-backed security. Investment banks then take multiple mortgage-backed securities and they package them into this new product called a CDO. They then divide these CDOs into different layers from safe, AAA rated, to high risk, BB rated or junk. Then investors such as pension funds and hedge funds come and buy these CDOs believing they are safe due to misleading credit ratings. The investors did not have a good understanding of what they're investing in and essentially are putting money in blindly. The same thing is happening with index funds today. Most index investors have no real understanding of what they're actually buying and how much these individual stocks in the index are worth. They just put money in every month as per what they were taught to do. Michael Burry thinks the same thing as he thought 18 years ago, that this is causing a bubble and that bubble will pop. There's a lot of money flow going into index funds right now, but as he says, quote, the flows will reverse at some point and it will be ugly when they do. For decades, we've had people almost in some manner blindly put their money into index funds. They don't understand the stocks. They haven't done the hard work to calculate intrinsic value, the affordability of the company's debt, the long-term durability of the company. No, they just consistently put their money in each week or each month. Is this viable over the long term? I guess we can only wait to find out.
I generally think of like the S&P a little bit of, it's a Ponzi scheme these days. 25, 30 years ago, 85% of trades were being done by like portfolio managers looking at companies or individual investors. And now it's like 95+% are just algos and passive. We've got it to a point where you get a job, they're going to start taking money out and putting it in the S&P for you. It's going to go into your 401k, you're automatically signed up, you know. And so they're forcing people to put their money in there. It's not really a true valuation tool of what is the real value of these equity companies anymore.
Because of this phenomenon of blindly putting money into certain stocks, it's caused all sorts of weird distortions in the market. Chamath Palihapitiya identified a different problem to Burry on X with index funds a few months ago. He wrote, average Americans buy S&P 500 index ETFs in part because Buffett told them to. They were told they would pay very little and get diversification in the 500 best companies on earth to ride out storms. But as concentrations rise in a very small percentage of those stocks, the risks don't fall, they rise. If the indices don't cap the max percentage of any one stock, you essentially are holding a direct bet on that one company. In this case, see that when you buy an index of 500 companies, you're rarely buying 10 companies with 490 others thrown in. If there is any market volatility, the lack of diversification could cause massive impairment. That's okay if you're a professional and that's what you're betting on, but most ETF buyers aren't professional stock traders and they will be in for a rude awakening if this isn't addressed. The graph that he's referring to in this tweet is this graph here. It shows how much of the S&P 500 is made up of the 10 largest stocks. What stands out to you about this graph? Since 2015, more and more of the S&P 500 got taken up by just those 10 stocks. It went from 18% a decade ago to 40% today. This means that if you buy the index fund, a large percent of the holding is Nvidia, Tesla, Apple, Amazon, Microsoft, Alphabet, and Meta. Instead of being diversified somewhat evenly across 500 companies, you're plowing your money into 10 companies. 10 of the most expensive companies in the world based on price to earnings relative to future growth. As much as I disagree with Chamath on certain things, he does make a fair point when he says, as concentrations rise in a very small percentage of those stocks, the risks don't fall, they rise.
Are index funds still a buy?
Index funds are not an investment choice you want to write off too quickly. There's a reason why Buffett time and time again in the past recommended it to his audience. This graph shows you the average annual return of certain assets from 1985 to 2024. Cash has given us basically nothing, forget about it. International bonds, yeah, not much at all, 2.7%. US bonds, 3%. Wages have grown by 3% each year. International stocks, 7.3%, and real estate, 8%. None of these over the 10% mark. But then we look at the S&P 500, and since 1957, it's delivered an average annual return of over 10%. So it's basically beaten most investment options. As America has grown, companies like Apple, Facebook, Amazon, Microsoft, Tesla, and Nvidia have expanded worldwide. The American investor profited from this through the simple tool of the index fund. It almost feels like a no-brainer just to buy the index fund when you look at how well it's performed in the past. But this is not a rare piece of information that I've given you. Everyone knows this about index funds, which has meant billions of dollars pouring into this asset class. What happens to an asset when everyone wants to buy it? This table right here shows us the S&P 500 companies by weight. I want to focus on the top 5 largest stocks because they make up such a large percentage of the actual index. Number 1 is this company here, Apple, worth 7% of the index. The stock that Buffett kind of sold out of nowhere. Apple has a PE ratio of 35. The price is 35 times more expensive than the earnings. With no growth, it will take 35 years to get your money back. Next in weighting is Microsoft, worth 5.8% of the index. Big company, been around for a while. Its PE ratio is 30.7. Price, 30 times more than the underlying yearly profit. Nvidia is next on the list. Nvidia has a PE ratio of 37. Amazon has a PE ratio of 35. And Meta has a PE ratio of 24. The top 5 stocks have an average PE ratio in the 30s, and they're not exactly just started their growth journeys. They're quite mature now, and the question comes, do they really justify that high a price? We are in a time where we must consider if we're willing to pay the high price to buy an index fund and just deal with the probable lower long-term returns. Either that, or we look for the alternative investment options.